the stock market. So whether the stock market is efficient or not, it certainly exists. And this is a picture of Wall Street from old-timey days. So I have a little bit of a write-up here. I've done some research on this independently, but just want to talk to you a little bit about the stock market, and then we're going to have another very brief video on the stock market crash of 1929, a little bit on the flash crash, and then onward. So to some extent, at least in some numbers, 24, I believe, originally, have been trading on Wall Street in New York. They actually began by trading at a coffee shop. Apparently it was right next to where General Washington would become inebriated on a routine basis. And they eventually moved into an establishment dedicated for trading on Wall Street. There's sort of an interesting background to this, which is that these traders actually met and sat or congregated around a buttonwood tree, which is kind of a scraggly, indescript tree in lower Manhattan, and signed an agreement, which is now kept at the New York Stock Exchange because it was effectively the charter, the founding document. And I have a quote here of what it says. "We, the subscribers, brokers for the purchase and sale of public stock, do hereby solemnly promise and pledge ourselves to each other that we will not buy or sell from this day for any person whatsoever any kind of public stock at a rate of less than 1/4% commission on the specie value, that we will give a preference to each other in our negotiations, in testimony whereof we have set our hand the 17th day of May at New York, 1792. So I alluded to this earlier. What is the problem with this agreement? Under modern law, what would be the problem with this agreement? Yes?
Lost the word.
Yeah, Danielle.
Colluding with each other to have this private club where they don't.
Yeah, this is naked price fixing. This is a per se violation of Section 1 of the Sherman Act. This is collusion at its finest. In bold, bright terms here, we will not buy or sell for anybody else. Okay, that's a conspiracy to exclude, and it's also price fixing. And they're setting a minimum rate for their services. So interesting that we hold this document up so high, but it would in fact be completely illegal under modern law, which I find just something kind of interesting, that we might not have the stock market if we had the antitrust laws that we do today. So the stock market then, in a way, began in 1792, but there were many stock markets at the time. As I mentioned, there's one in Philadelphia. In fact, there were stock markets in almost every region. Why would there be stock markets in virtually every city? Why not just have one stock market? Tyler?
Harder to travel.
Yeah, how long did it take to get from Washington, D.C. to, Boston in those days? I mean, this was your transport if you were lucky. Note the horse. So getting to another market was slow. Information traveled slowly. Now, there is an invention, though, that happened that changed not just how people traveled, but how information traveled. I think there are two fundamental inventions in American history that changed and caused the consolidation of stock markets. What was the first invention that changed how information could travel in America? Yeah, Dave. So the ticker tape came a little later, and the ticker tape was built on a prior technology, kind of like how email is built on the internet. So the telegram. The telegram was the way of transmitting information. Later, the ticker tape was effectively a way of automatically changing the signals. It was a very early version of binary to analog conversion, digital to analog conversion. DAC. It was your first DAC, if you want to think of it that way, because it would take dots and dashes and spit out letters and numbers. But it was, in fact, that signal that could travel that meant that at the speed of light, electricity travels at the speed of light, you could be in Omaha, Nebraska, purchasing and trading on securities in New York. And then the other invention which transformed America was the railroad. And they often grew up side by side. Telegraph lines would often be run alongside railroad lines. One thing I also find very interesting and have written about is that the telegraph and the railroads did not only transform markets, but they needed markets. Why would the railroad need a stock market? I argue that the railroad could not have existed without the stock market. Yeah.
It's very expensive to build tracks and.
Railroads are stinking expensive. I mean, that stuff is really pricey. You gotta get iron out of the ground. You gotta forge it into steel. You have to hire thousands and thousands of men, it was men working on the railroads in those days, to lay track clear across the country. Telegraph lines have copper. Copper is expensive, not quite as expensive as the railroads, but relatively expensive. And by the way, controlled almost exclusively by one company. What was the company that had the monopoly on the telegraph lines? No, I don't think that's. This is my trivia game. So I'm just going to go ahead and say no. Just wasn't Bell. Western Union. Western Union controlled that, and in fact controlled a lot of the hubs, and so they were engaged in their own types of price-fixing activities as well. It's something called a network industry. Effectively, you only need one telegraph line, and there are efficiencies to having all of them. So these are areas where the antitrust story that I bring up here plays into a lot of the story about the railroads. The railroads are what gave rise to the Sherman Act and trust busting, and that takes us back to Brandeis. So by the early 1900s, 1915 or so, the nation was pretty much covered in rail and telegraph lines, and anyone could invest from anywhere. And a huge percentage of American people were investing, but they're investing under a number of different laws and very, very spotty policing of regulation. I mean, it was very decentralized. There was no federal laws about securities. The Federal Securities Act was not enacted yet. So in this early time, it was up to the states. And the states didn't get around to regulating securities until 1911, which was back to our trivia game here, first state to create a securities law. It was not New York, actually. It was not New York. It's not New York. Interesting, right? You would expect New York. It was Kansas. Yes, Kansas passed an act to provide the regulation and supervision of investment companies and providing penalties for the violation thereof. That was the first comprehensive securities regulation passed by Kansas, of all places, in 1911. Now, actually, maybe it's not so surprising that it wasn't New York. Why, perhaps, would Kansas and not New York regulate investment companies? Who do you think, do investment companies want themselves to be regulated? Most companies do not want to become regulated. They fight that tooth and nail. So the investment companies are in New York, but being rich and powerful, most likely, I would assume that they would be lobbying the New York legislature not to regulate them. Whereas where are the investment companies not? Kansas. Not a lot of investment companies in Kansas, but some number of farmers that could potentially lose their life savings. So in Kansas, and not New York, is the origin of the state securities laws. So there's that larger picture, Wall Street, May 17, 1792. So that's kind of our beginning of the story. And note, this is right after the nation's founding. By the way, what was bought and sold on these markets? What kind of companies were traded? What are some of the earliest corporations in America? Yes? Mining? Wasn't mining yet. No, the earliest companies. There were a couple, that's true, but they didn't have the same kind of capital requirements. Remember, just like the railroads that came later, we have to deal with companies that need huge amounts of capital up front. Who needs a lot of cash? The banks. Yeah? The banks. Most of the early stocks were bank stocks. And they created a bubble. How did they create a bubble? The money that was invested in the banks would then lend out and invest in other things. And it was like a series of Russian dolls. You think that the credit default swap is messed up, where everyone's, all integrated in their investments. But early on, the investments were in banks, and the banks were making their own investments, and there was no regulation on any of it. Things got pretty hairy, and there were a number of crashes in early American history. 1872 was a big crash. There was a crash in 1849, I think it was. And so there were a series of crashes throughout history, and in a large part it was because of the interrelation of banks as depository institutions, investment institutions that gave rise to some of the New Deal regulation. All right, so anyway, there's a couple crashes here and there, but nothing hit Americans as hard as the stock market crash, which, you can pick your dates, but effectively went from October 24th to October 29th was the period of precipitous drop. And just to give you a sense of the magnitude, in August of 1929, the Dow Jones Industrial Average was around 5,500, 5500. After it's basically a weighted average. It's not really a dollar amount. It doesn't directly translate, but you can just think of it in relative terms to other measurements. It fell to around 600 at the bottom of the Depression in 1932. May 1932, I want to say. Meaning the stock market lost 90% of its value. And we can measure that in billions at the time, which we can translate into trillions and trillions of dollars today. Wiped out. Wiped out. My grandpa was selling apples on the street corner. I mean, things were rough, That stock market did not get back up to its value of 5,500 or 5,600 until I believe it was 1957. So the effects of the Depression lasted quite a long time. Now the causes of it are more complex, and we don't have time here, nor do I have the expertise to really explain what people have been writing about that for a very long time. I don't think it has been resolved. But some of the effects were pretty significant. Now, I'll talk mostly about the domestic effects, but it also probably precipitated the war in Europe. What was happening in Germany in the time leading up to the crash? Yes?
Versailles, the Treaty of Versailles.
The Treaty of Versailles. What did the Treaty of Versailles do to Germany?
Reparations.
Paying reparations. Can you explain what reparations are?
So, in a pre-World War, like World War I, that's pretty much when it stopped. Reparations were basically paying, the loser had to pay back all the other countries
For being a very naughty boy.
it's
Cause-
basically like a fine.
Yeah, basically a fine for starting a war and losing. It's really a bad idea. If you ever start a war, you should definitely win. Okay, that's like one lesson history has taught us. If you lose, and at least in this area, you pay reparations. So Germany is under this heavy, heavy load, and they have to borrow to pay back their reparations. They didn't have enough cash on hand, so they're actually going further and further and further into debt. What happens when the stock market goes from 5,500 to 600? What happens to borrowing? What happens to capital? It freezes. There is no more cash floating around, certainly not for Germany. Too bad, so sad. Don't know how you're going to pay your reparations. Did the world let Germany off the hook? No. So what happens in Germany? Massive inflation. People are driving around wheelbarrows through the streets with their currency. People are trying to spend their money between when they're paid and when they go home because their value of their money they're being paid is losing by the hour. It was crazy. And the Depression had a huge role in creating that circumstance in Germany. And, well, we know what happened next. This was felt all over the world. It wasn't just an American problem. But it, in many ways, began here. And